Hello, greetings, and welcome to Dividend Blasters. This is our 73rd video. My name is Bob. As you know, I haven't done a video in a few months. I've been very busy. Life has a way of interfering with some of the things we love to do, and I do love to share my knowledge in these videos. Our topic today, ETF beasts. These are my absolutely favorite ETFs that I'm going to share with you. I'm calling them killer compounders and cash flow machines. I'm going to cover these and I'm going to cover them briefly, and I'm going to give you a handful of categories that these killer compounders and cash flow machines fall into. First one is broad market exposure. Second one is large cap. Third one is dividend growth. Those are for market exposure and, of course, dividend growth, those first three. The next four are essentially cash flow. They're covered call ETFs. One category is monthly payer medium distribution. Another one is covered call monthly payer medium high distribution. The next one is covered call weekly payer high distribution. And then the last one is Bitcoin exposure. I'll talk a little bit more about that later. First, a little housekeeping, a quick disclaimer. I'm not your financial advisor. Purpose of this video is for information and education. It reflects my own opinions and my experience as an independent investor for more than 30 years. I've been doing this a while. I'm primarily a stock investor, and that's where I got my start. Then in the last 10 years, branching out more and more into ETFs. I like the compounding aspect of it. I also like the risk diversification that some ETFs offer. Some are better than others, and some are better suited for some folks than they are for other folks. But anyway, bottom line, do your own research, consult a financial advisor prior to making any financial investment decisions. All right, first one. And I talked about broad market exposure. The first one is the Vanguard S&P 500 ETF, ticker symbol VOO. This is one of the older ones, founded back in 1976. It's a very simple methodology. It tracks the performance of the S&P 500. It has a very low expense ratio, 0.03%. So what does that mean? What that means is that for every $10,000 you invest in this ETF, you will pay a management fee of $3. They all have overhead, they all have fees, they all have to get paid. $3 is cheap. This is one of the cheaper ones. That's what I like about this. You've heard of the saying, buy the market. Don't try to time the market, but own the market, buy the market. That's why I have this in my portfolio. This is one of the bigger ETFs out there. It is the second largest ETF in the world. And we measure the size by its assets under management. All the stocks and equities that they own amount to about $1.37 trillion. The only one larger is another Vanguard ETF. It is the total stock market ETF VTI at 1.84 trillion. Number three is SPY by State Street Bank, about 639 billion. Um, it's also an S&P 500 ETF. IVV managed by BlackRock. It's another S&P 500 ETF, 603 billion. The S&P 500s tend to dominate these top five, top 10 or more ETFs in size. VXUS is number five. That is the International Stock Market Index ETF, and that's also a Vanguard ETF. You know, there in VOO there's 507 holdings. The top 10 are Apple, Nvidia, Microsoft, Amazon, Meta Class A, Google Class A, Tesla, Berkshire Class B, Google Class C, and I got to say, really one of my favorite chip making stocks, Broadcom, that pays a dividend. Those 10 account for almost 35%. You know what you're going to see? You're going to see a lot of overlap in holdings across many of these ETFs. What's different? The difference is going to be the allocation. And there'll also be some difference in holdings. usually in the bottom 5 of the 10. Uh, those top three will rotate as Apple, Nvidia, Microsoft do trade places at the top of the food chain in market cap. Right now, it's Apple, but it had been Nvidia. Before that, it was Microsoft for a long time, and they've been trading for the last year or so several times. Um, anyway, just in case you're wondering, and this just as an aside, looking at the holdings, Meta Class A shares, those are basically the shares that we all own for Meta platforms. There is a Meta Class B, which are privately held shares by people like Mark Zuckerberg, which have more voting rights and more ownership authority, if you will. The Google Class A, they have voting rights versus the Google Class C, which don't have any voting rights. But the trade off is that the Google Class C shares are a little bit cheaper. So if you don't care about voting, you'll get a cheaper price on your stock and maybe a better total return. The Berkshire Class B, uh, those are the more cheaper stocks that many of us own, which are in the $500 range. Not cheap, versus the Class A, which go for like $500,000 a share, and they both have voting rights, but the Class A shares have much more voting rights. You can also convert Class A to Class B. So anyway, just a little bit of background on some of these different classes of shares. In case you're wondering, people sometimes ask me that. Wanted to get that out of the way. Got to do a little bit of a drill down into VOO. The price as of December 24th, which was a couple days ago, was $552.82. It's not cheap. Keep in mind that in some of these stock trading platforms, you can buy fractional shares, like in some of the newer platforms like SoFi or I believe Robinhood. Schwab, which I use Schwab and SoFi. Schwab, you can't buy fractional shares of ETFs. You can buy fractional shares of stocks, but that's one area I think where Schwab can do a little better. But I'm a big fan of Schwab. I already mentioned the assets under management. It's 1.3 trillion. The dividend rate, the dollarized rate, is $6.70 right now, the forward rate, if you will. It's about a 1.23% dividend yield, a forward yield. What you would see in a lot of these S&P 500 ETFs is that they have a lower yield. When you buy the market, you're buying everything in the S&P 500, and a lot of those stocks don't pay dividends, so they pay modest dividends. So that's really what's the story there. The dividend growth rate for the last 5 years, it's not bad. It's 3.77%. I would not sneeze at that. It's a quarterly paying dividend. The return, the price return year to date since January 1, very beginning of this year, which is essentially the last year, 26.5%. So that's really the S&P 500. Total return is going to be a little higher because there's a little bit of a dividend that they're accounting for, small dividends, about 28%. Uh, which essentially, if you're looking at dividends reinvested or dripped, that's the difference between the 26.5 and the 28%. Last 5 years, price return 87%. Total return, again, with dividends, 102, almost 102.5%. Uh, Patty, which is projected annual dividend income given a $10,000 investment. I like this metric and I use this to compare ETFs. It's not bad, with a 1.23% yield. It's going to be about $121 in dividends. So about $30 a quarter. That's going to translate, if you have your auto drip on, about a fifth of a share a year. It's not bad. It's not bad. It could be higher, but it is what it is. You're buying the market. So that's VOO. Let's go to the next one. Next one for market exposure is Invesco's QQQM. It is the Invesco Nasdaq 100 ETF. So the last one was S&P 500 index that VOO is replicating. QQQM replicates the Nasdaq 100. This is a newer one. This was found back in October of 2020. It tracks the performance as I mentioned, of the Nasdaq 100 index. It replicates it. Uh, Expense ratio is a little higher. It's 0.15%. Assets under management is a little smaller. It's a little under $40 billion. Um, uh, One thing I'll say about the Nasdaq 100 is that it's hot, and it's been hot for most of the year. It's a little bit more volatile than the S&P 500. It is very heavy with tech stocks. So here you're going to see a higher allocation, really to the Apples, the Nvidias, and the Microsofts, the Amazons, and Broadcoms, and Teslas, um, versus in an S&P 500 ETF, where you might see 5 or 6% allocation versus 10%. A little bit more volatility, so a little bit more risk, but more reward. But it's an ETF, so you're diversifying that risk out through 103 holdings. And it's a very a safe investment. You may have heard of QQQ. This is QQQ's little brother. They're both managed by Invesco, but what is the difference? QQQ is much older. QQQ is much bigger, and QQQ has a higher expense ratio of 0.2%. So you might ask, well, why would I invest in QQQ when I can get a cheaper ETF for QQQM? And QQQM is cheaper in price and it's cheaper in its expense ratio. So every $10,000 here, it's $150 a year. I'm sorry, $15 a year. It is cheaper. It's The difference is it depends on what you're trying to do. If you are a long-term investor, QQQM is the better ETF to invest in. If you are a trader and you are trading stocks and you are selling and buying options, and you need to have efficiency, you need to have trades executed quickly by your platform without delay, it's QQQ you need to go with because they're bigger, they have better liquidity, they're going to be able to execute your trades quicker. And when you are buying and selling, uh, options, or you're doing day trading, you need to be efficient and you need to move quickly because every second counts. Um, I mentioned it's 103 holdings, top 10 holdings. Again, Apple, Nvidia, Microsoft, Amazon, Broadcom, Tesla. You can read them there. And I talked about the different classes of shares with Google and Meta. These 10 account for 52.5%. So that's the difference between like 35 and 52%. There's more tech here, and it's going to be a little bit more volatile, but volatility is good. That's where you get your gains from volatility. Doing a deeper dive, $218 a share for QQQM. I already mentioned assets under management of 40 billion. Dividend rate, it's modest. Forward rate of $1.28. Yield is 0.63%. Again, a lot of these stocks tend to be much higher priced, with modest yields, and that yield percentage is small. But you don't buy this for the dividend; you buy it for the growth and the capital appreciation. This is a quarterly dividend payer. Price return a little bit better than the S&P 500 for year to date, about 29.5%. Total return a little bit more, a little over 30%. Last 5 years, 80% price return, total return 85%. The Patty for a $10,000 investment, it's very modest. It's 58%. So again, if you're buying if you're buying Nvidia, or you're buying Microsoft. Microsoft's a good dividend payer, but if you're buying Nvidia or Tesla, you're buying it for the growth. You're not buying it for the dividend. So let's go to the next one. The next one is for market exposure, but it really is a little bit different than the first two. The focus here is on large cap stocks, and this is managed by Charles Schwab Investment Management. Schwab, and it's called the Schwab U.S. Large Cap Growth ETF, founded back in 2009. So they've been around for about 15 years. They track the total return of the Dow Jones U.S. Large Cap Growth Total Stock Market Index. Also, a very low expense ratio, 0.04%. So it's close to the VOO expense ratio, but it's cheaper than QQQM. But it's doing something a little bit different. Assets under management, a little under 38 billion. Has 228 holdings. You'll see some overlap here, but again, where's the difference? It's in the allocation. Apple, Nvidia, Microsoft are the top three. But again, you're looking at 11, 12, almost 13% in these allocations of the top three. And then there's Amazon, Meta Class A, Tesla, Google A, Broadcom, Google Class C. And here's something new that we haven't seen yet in the top 10, Eli Lilly, the drug manufacturer. And of course, they're very successful with their weight loss drugs like Manjaro, of course, and you know they're. I'm blanking on some of these, but Manjaro and Zepbound are a couple of them that are very successful, and people take these to kill their appetite and lose weight. Those top 10, and here's something interesting, account for almost 62%. So almost double what we saw with the VOO allocation of the top 10 holdings. These are they tend to be tech heavy, but these are really just the top 10 large cap, if you will. We'll do a little deeper dive on SCHD. Very cheap right now. It's 28.94. One thing to note is that SCHG went through a 4-to-1 stock split back in October, as did a whole bunch of the Schwab ETFs back in October. SCHD also did. They did a 3-for-1. This was 4-for-1. Dividend rate 11 cents per share. That's the forward rate. The forward yield, very modest, 0.39%. You're not going to see much of a dividend growth rate here. Last 5 years, it's a negative growth rate, minus 0.3%. Again, you're not buying this for the dividend, you're buying it for growth. If you are buying an ETF for a dividend, and it has a negative dividend growth rate, you need to sell it. Or if you're buying a dividend stock, a dividend growth stock, it has a negative dividend growth rate, you need to sell it. Now, if it's a dividend cash flow stock or dividend cash flow ETF, that's different. It's different. And I'm going to get to that in a little bit. The last, year to date price return, almost 40%. It's pretty good. Total return, including that modest dividend, a little over 40%. Last 5 years, almost 150% price return. Total return for the last 5 years, 156%. So we've had, let's just step back for a second. When we look at the price return for year to date and the total return for year to date versus the price and the total return for the last 5 years, stock market has done really well. You've heard of the saying, don't time the market. It's a fool errand. Buy the market, be in the market. That's why we do this. If you look at the last 30 years, you might have an off year every 5 years, but you're going to have many, many on years, and you're going to make money. So play the long game. Get started early. It makes it easier to play the long game. The projected annual dividend for $10,000 investment, a modest $38. All right, next one. Next one. Oh, this is absolutely one of my favorites, and I'm a dividend investor at heart. I do invest a lot in growth stocks and other things, but I love dividends, and I'd have to say my favorite dividend ETF is SCHD, and they play the long game, and they have a wonderful, unique automated algorithm. That's a whole other video I'll get to another day. But this is the Schwab U.S. Dividend Equity ETF. They're managed by Charles Schwab Investment Management, founded back in 2011, so they've been around a little more than 13 years. They track the performance of the Dow Jones U.S. Dividend 100 Index. They replicate it 100%. Their expense ratio, a little bit higher than SCHGs and VOOs, less than QQQMs. It's 0.06. So every $10,000, you're going to pay $6. The assets under management really quite impressive. These are not nearly as big as the S&P 500 index ETFs, which everybody puts their money in. These are more specialized. 64 billion. It has been really the most popular dividend uh, growth ETF in the world in the last, I'd say, 5 years. 103 holdings. Uh, this is different. These guys do this differently. I mentioned they have an automated algorithm that decides who goes in to their holdings and who gets kicked out. And they've kicked out good companies just because of the algorithm. And people are like, oh, what the heck? Why would they? You know, it's not personal. And these other companies, they come back in. But let's just go through the top 10 and basically, Pfizer, okay, AbbVie, a couple of, you know, big pharmaceutical companies, BlackRock, the hedge fund, Coca Cola, Cisco Systems, Bristol Myers Squibb, another drug company, Texas Instruments, Amgen, another drug company, PepsiCo, and the defense contractor Lockheed Martin. What you see here is you see really good dividend paying companies. And I think I counted four pharmaceutical companies, which tend to be high dividend paying companies that have a long history of consistent growth. AbbVie has been doing it for 20 years. Pfizer, I want to say 13 or 14 years. BlackRock, the hedge fund, they have a nice dividend. They're very expensive. They're around $1,000 a share, but they've been paying a growing, continuous dividend for many years. So that's actually uh, uh, interesting. Those holdings are very different from what you've seen. Those top 10 account for about 41%. We'll do a little bit of a deeper dive here. Price 27.59 a share. I already mentioned the 64 billion assets under management. The forward dividend rate 99 cents per share. They yield us a decent. When I buy a dividend stock or a dividend growth stock or a dividend growth ETF, I'd like to see something more than 3.5%. 3.63% is nice. What I really, really like about this ETF is that they have consistent predictable dividend growth. Last 5 years, 11.6%. What you're going to see when we get to the cash flow ETFs, you're not going to see that because they do something different. They are selling call options, quote, out of the money. I'll talk about that later. So they don't focus on dividend growth. They focus more on higher premium income or cash flow. Anyway, back to this. This is a quarterly paying dividend ETF. Year to date, the price return, not bad, a little under 9% total return. So you're going to see the delta between the total and the price return a little bit more. It's about 4% difference. It's about 12 and 3/4%. And that's because of those wonderful dividend paying holdings that they have in the ETF. Price return for the last 5 years, almost 43%. That's pretty good. And the total return for 5 years is 70%. So what's different here is you will get a little bit of less price appreciation than you'll get in the S&P 500 ETF, but you're going to get more dividends. Really depends on how you want your return. But what I like about this is that you get a decent amount of price return or capital appreciation. The projected annual dividend income given a $10,000 investment, almost $360 a year. So if you have your auto drip on, you are going to be dripping. How much is that? It's more than 10 shares a year. It's probably 15 shares, maybe. About. I'm doing that in my head. All right, let's go to the next one. Next one. Okay, so now we're actually moving away from the broad market exposure and the dividend growth to the cash flow ETFs. And this first one is the JP Morgan Equity Premium Income ETF. It is managed by JP Morgan Asset Management. Okay, and they were founded more recently, just 4.5 years ago, back in 2020. And these are a little bit more complicated. They do not depend on paying out dividends just based on their holdings. They do a couple of things. I'm going to read this and I'll talk a little bit about it. They seek to provide current income to the investors while maintaining prospects for capital appreciation. I'll talk a little bit more about how they do that. It really amounts to the timing and how they sell their options. They seek to achieve this objective by one, creating an actively managed portfolio of stocks comprised significantly of those in the fund's primary benchmark, the S&P 500, and through equity linked notes. This is the important part. Selling call options with exposure to the S&P 500. So, okay, their underlying market index that they have exposure to, the S&P 500, they're selling options against that, call options. Expense ratio is a little higher. It's 0.35%. Why is it higher? They're doing work. So if you've ever sold options, you know it's a little bit of work. Well, they're doing it on your behalf. So you need to pay them for it. And they do a decent job. The assets under management, a little under 38 billion. This is one of the quicker growing, I'm going to call Cashflow ETFs. They have 132 holdings. So they don't hold everything in the S&P 500, which is their underlying market, but they own about a fifth of them, if you will. And the top 10 are, and you can see that the allocations are much less. They're all less than 2%. Amazon, Meta Class A, MasterCard. I haven't seen that one yet. It's a wonderful payment technology / credit company. Nvidia, which has been on fire the last couple of years. I own several shares of that. ServiceNow, another tech company. Progressive, the insurance company. Train Technologies, Visa, another payment technology platform / credit card company. Google Class A, and Microsoft. Now, these only count for 15.9%, but they have a lot of shares or a lot of holdings at very little percentage prices. They go way below 1% for several of these. We're going to do a little bit of a deeper dive here. This is trading for a little under $59. The assets under management, 38 billion. Forward dividend rate about 382, and the yield 6.54%. We don't have a dividend growth rate for the last 5 years. They haven't been around that long. They've been around for about 4.5 years, so they haven't started tracking that. We could estimate that, and I do have a number that I'll share with you later. Price return for the last year to date, 7%. Total return, 14.35%. So almost double the price return. And what is it? That's dividends. That's about a third of the delta, but 2/3 of that, the premium income from the covered call options that they sell. Don't have 5-year data on price or total return. Higher projected annual dividend income given a $10,000 investment, about $649. So quite a significant increase. So what you'll see is lower price return, but more dividend income. And it really depends on what it is that you want. Me being closer to retirement age and wanting to flex into some more cash flow, I am heavy into JEPI and into the next one, JEPQ. Let's go to JEPQ. JEPQ is the JP Morgan Equity Premium Nasdaq ETF. Excuse me. And I left Nasdaq out there, but that's what this is. It's managed by JP Morgan Asset Management, founded in May of 2022. The methodology for JEPQ is the same as JEPI. The difference here is that the underlying index that it seeks to replicate, its benchmark, the index that it writes call options against and has holdings of, is the Nasdaq 100. So they own shares in the Nasdaq 100, but they use, again, equity linked notes to sell call options with exposure to the Nasdaq 100. Same expense ratio, 0.35%. Assets under management, a little under 21 billion. 104 holdings. What you see here is you will see the same top 3 holdings essentially as we see for the QQQM. for SCHG, also for, I believe, for JEPI as well. I have to go back, but the allocation is a little higher. We're looking at 7 and 8%. And then you have Amazon, Google, Broadcom, Tesla, Meta Class A, Netflix. Haven't seen Netflix. And then we have call options, and those account for about 46% of their total holdings. Doing a deeper dive, this is selling for a little more than 58 bucks a share. I already mentioned the assets under management. Forward dividend rate right now is $4.99 and a yield of 8.58%. I got to say, let me just caveat this with these cash flow ETFs that rely on selling call options. Um, you are not going to see a consistent dividend rate every month. It's going to change. It's based on the holdings, but that's really about a third of it. Two-thirds of it are really based on the premium income from the call options that they sell. And those are going to fluctuate just depending on how successful they are, how the direction the trades go. A couple months ago, it was I think it was $5.24 a share. Now it's $4.99. It'll go back up. It tends to go up and down, but the important takeaway here is that the yield tends to fluctuate between 8.5, 9.5, 10%. So you're getting a healthy dividend yield, and that's what you want if you want that cash flow. Um, you don't see a lot of. There's a little bit of fluctuation, but not a lot. There's a little bit more here than in JEPI. If you look at the price return year to date, it's very nice. It's 16.5%, a little more. Total return almost 28%. Year to date, those are nice year to date figures. 5 years, we don't have that information. They've only been around for about 2.5 years. A little bit higher projected annual dividend income because of the higher dividend yield. It's going to track right now at this point in time. We would project around $858. Now, next month, our projection could be different based on the yield. These are forward projections. That's important to note. But you're not going to see wide fluctuations in the dividend yield. They tend to be high based on their business model, which has been very successful. So those are JEPIs. Now I'm going to cover three with NEOS, the NEOS S&P 500 High Income ETF. They're managed by NEOS Investment Management. These guys are very new. They were founded back in 2022, so about 2.5 years old, about the same age as JEPQ. Their approach is similar to JEPI's, and their methodology is this: they invest in stocks that make up the S&P 500 index, and they have a call option strategy. They write a mix of written call options and long call options on the S&P 500 index. So that's really what they're doing. They are basically selling call options to maximize premium income. Now there's 510 holdings. Top 10 holdings, top three, there's really no difference there. Maybe a slight reshuffling of the top three, but right now it's Apple, Nvidia, and Microsoft in the 6 and 7 and 7.5% range. Then Amazon, Meta Class A, Tesla, Google Class A, Broadcom, Google Class C, and Berkshire Hathaway Class B. About 37.33% for those top 10 holdings. Doing a little deeper dive, SPYI is trading for a little more than $52 a share. They have 2.61 billion in assets under management, which they've been growing quickly, and I'd say quickly in the last 5 or 6 months as they've gotten more and more traction and good buzz in the industry. The forward dividend rate is $6.09. The yield is a little higher than what we've seen like with JEPI and JEP2. It's 11.7%. It's a monthly payer. We don't have a 5-year dividend growth rate average yet. Price return year to date, a little under 8%. Total return, a little under 22%. These are 5-year, actually, they're 2.5 5-year averages in price return and total return, a little under 6%, and then a little more than 40% for the 5 years. You'll notice that because of the higher yield, the projected annual dividend income would be about a little under $1,200 a year. Okay, next one. QQQI. This is the NEOS Nasdaq 100 High Income ETF. Everything I just said about SPYI applies, except swap out S&P 500, swap in Nasdaq 100. 107 holdings, top 3 holdings, no change there, except maybe the allocation is a little different. Apple, Nvidia, Microsoft. And then you'll drop into Broadcom, Amazon, Meta Class A, Tesla. Then you have the Googles, Class A and Class C. And then, Costco. I got to tell you, I love Costco. I love shopping there, and I love buying their stock and getting their dividend. Just as an aside, last year, got a special dividend, $15 a share, in addition to the quarterly dividends. Wonderful. So those top 10 account for a little under 53%. Doing a slightly deeper dive, it's trading for about $53.57 a share. Assets under management, $750 million. Dividend rate, $6.11. Again, this yield's a little higher. It's about 11.33%. It pays monthly. Since these are fairly new, they don't have a dividend growth rate calculated for the last 5 years. Year to date, price return a little more than 7%, total return 22%. And that is basically double the price return, triple the price return, if you will. And what's the difference? It's the cash flow. If you're reinvesting and dripping, you're building your holdings. No price return or total return metrics available for 5 years. Projected annual dividend income, about $1,140. Not bad. Next one. Okay, here's something different. So this is the last one with NEOS, and this is the NEOS Russell 2000 High Income ETFs. They're really the small cap companies that they invested for this ETF. Founded earlier this year, about 6 months ago. I could swap out everything. I could basically say, yeah, the approach is exactly the same, except instead of S&P 500 or Nasdaq 100, it is the Russell 2000 index that they invest in and that they write call options against. 7 holdings, they invest in the Vanguard Russell 2000 ETF, and then they have treasury obligations, and then they have their options, and that's 101%. Okay, so drill down. Price little under $50. This is much smaller. It's about $134 million. Assets under management. Forward dividend rate, $3.69 today. Again, this could change in another month. The yield is a little bit lower, 7.44%. That's because some of these companies are smaller. They have less liquidity. They're going to pay lower dividends. And the options are probably not going to be quite as rich, if you will, as with the Nasdaq 100 or the S&P 500 options are being written. Price return is a little bit negative, minus 0.87%. And you know what? That is not to be, that's to be expected with these, because you're getting more back in cash flow. So here, year to date, 7.88%. We don't have 5-year metrics. The projected annual dividend income is $744. I don't have a lot in IWMI. I have a little bit, and I have it more for the exposure to that small cap stocks and a little bit of the cash flow. But I'm a little bit heavier in the SPYI and QQQI. All right, that covers it for the NEOS family of ETFs. Now, here we're going to do something a little different. These are the Roundhill ETFs. I've got 3 of them here. I'm going to go quickly. And this is first one is the Round Hill S&P 500, 0 days to expiration. That's what zero DTE means. Covered call strategy ETF. It's XDTE, and this is a weekly pair. So if you want weekly dividends, these are the ones you want. How is this different? Well, it's weekly, okay, but they do basically use a covered call strategy against the S&P 500, and they sell call options against the S&P 500. 8 holdings. They have an option on the S&P 500, and then they have treasury obligations. Deeper dive. $51.75 a share. Assets under management about 282 million. So some of these newer ones, they're much smaller in assets under management. They're a little bit more specific and unique to people's taste. Some people want those weekly dividends. I like them. Is all my money in these? No. But I use it to supplement my portfolio, and I like that extra cash flow to give my portfolio a nice shot in the arm. I like that higher forward dividend rate of $9.60. The yield is high. I mean, that is a beautiful yield, 18.61%. Again, weekly paying. Price return year to date, well, it's negative. Okay. And why is it negative? It's a little bit of what we would call NAV erosion. I'm okay with a little NAV erosion if my total return makes up for it. So the total return is 18.65%. Now, do I reinvest all of it back into these? I reinvest some of it, sometimes more of it, but I also take some of that cash and I reallocate it and redeploy it into my portfolio, into other ETFs and into other stocks. That's really been my strategy. So I'm using my money, my holdings, to make more money. We do not have 5-year metrics on price or total return because they're new. But look at that projected annual dividend income. It's about $855. So a huge increase, if you will, from the others. Let's go to the next one. Everything I just said applies except for QDTE. It's the Nasdaq 100 index, where there's the exposure and the options are written against it. And QDTE is the Round Hill Innovation 100, 0 days to expiration covered call strategy ETF. So here we go. And you can see the holdings, and there's just a few of them, but they're all call options, if you will. I'm going to do another video another day on options strategy, but that's not today. We're running a little bit long, and I want to move quicker. So, deeper dive. QDTE trades for a little more than $42 a share. This one has come up quickly because of the run up with the Nasdaq 100 and in the tech stocks this past year. They're about $630 million. Not huge, but again, this is a specific, unique ETF. Dividend rate $12.04 a share. The dividend yield is very high. The distribution rate is almost 29%. It's a weekly payer. Price return, well, it's negative. Okay, you don't buy this for the price; you buy it for the total return. So you're going to get a negative price return of almost 9%. This to me is something that you want to generate cash flow quickly. So you're going to get almost a 21% total return. So the projected annual dividend income from this would be about $2,859, which is pretty massive. And again, you can redeploy that. And this is not advice. This is what I do. And works for me in my unique situation. Last one, RDTE. So everything applies except we're not looking at the S&P 500 or the Nasdaq. We're looking at the Russell 2000, RDTE. Deeper dive, $42 a share. Much smaller, $179 million assets under management. Forward rate, $4.16. The yield is a little under 10%. That's pretty decent considering the price. It's only $42 a share. Slightly below 0% price return, but that total return is 9.33%. You're getting that back in cash flow. Last one, and this is very different. And I wouldn't call this market exposure, or I wouldn't call this cash flow. I would call this Bitcoin exposure because Bitcoin is different. Bitcoin is not a stock or an equity. It's a, you know what, people have been debating, is it a commodity or is it a currency? I own Bitcoin. I have a handful of them in one of my retirement accounts, and I'm glad I do. And I got in for a fraction of what it's going now. Last I checked, it was 95, a little bit volatile. They've gone up over 107,000 last week. But I got in a fraction. I got a handful, so I'm very happy with that. This is IBIT, and this ETF is managed by iShares, which is owned by BlackRock. And there are several ETFs owned by BlackRock and managed by iShares. The iShares Bitcoin Trust ETF, founded back in June of 2023, and it reflects really the performance of the price of Bitcoin. And that's all it is, the price of Bitcoin. Um, I got to tell you that, again, I just want to stress this. This is not, you're not going to get cash flow from Bitcoin, but you will get exposure to this asset or this commodity. And what you're looking for is price appreciation. Um, and what I like about Bitcoin, I just want to say something about Bitcoin, is that Bitcoin is limited, and it will be limited. There will only be 21 million Bitcoin in the world. So it's impossible for it to be inflationary. It's also not managed or owned by a central bank like the Federal Reserve, which can um, increase or decrease interest rates, or increase or decrease money supply and change the value of your money. This is basically decentralized. Nobody owns it. The blockchain owns it and manages it. And the 21 million Bitcoin is the perfect monetary policy because it's really zero inflationary. So the value of Bitcoin should continue to go up, but there will be volatility. You just need to be aware of that. So let's do a little deeper dive here. The price of IBIT right now is $56.23. What's amazing about this is the size. Considering that this is only a year and a half old, it's over $51 billion in assets under management. People have seen the performance of Bitcoin, in particularly the last year, and they've been pouring into ETFs. They're not comfortable buying Bitcoin. They don't understand how digital wallets work, but they want to have some indirect exposure, so they're buying the ETFs. BlackRock is a leader in ETFs, and they've been really the 800-pound gorilla of the handful of hedge funds and asset management companies that have been getting into Bitcoin ETFs. And so they're big. No dividend rate, no dividend yield, no dividend growth rate. No surprise there. The price return and the total return are the same because there's no dividend. It's year to date, it's been 108%. That's really quite impressive. So it really just depends on how Bitcoin does. I will tell you, I'm optimistic. We have a new administration here that is very pro cryptocurrency and pro Bitcoin. So stay tuned on that. But those are my favorite ETFs, and I am happy with them. I do want to mention that I am an affiliate partner of Seeking Alpha. It's a wonderful publication for investment managers, investment analysts, and investors. I've been a subscriber for many years. I am a subscriber to the premium subscription, and I am also a subscriber to several of their subsidiary prescriptions. I subscribe to one on REITs. I also subscribe to another one on Alpha Choices, if you will, where you get two recommended stocks every month. But what I'm offering here is a $30 discount. If you use my affiliate link, you'll get $30 off the premium subscription for 1 year, $269. You can also get a 7-day free trial. If you don't like it, cancel it. So that I can offer you. Uh, and I love seeking alpha. So just to kind of wrap a bow around this, here's just a graphic, if you will, or a Venn diagram where you have your compounding ETFs, broad market exposure, large cap, and dividend growth, really in one um, circle or area, and I call them compounding. That's where the compounding happens through capital appreciation and dividends. Some pay more than others. That's fine. And that's the yellow circle. And then in the orange circle, you have your cash flow ETFs, your covered calls, and not really compounding because well, a little bit of compounding, but it's really more cash flow, if you will, some compounding. You could actually have the yellow and the orange overlapping a little bit, but it's really more about cash flow, generating the cash flow. You could drip back in or you can redeploy. I do a little of both. And then, of course, I have speculation with the Bitcoin ETF IBIT. So those are mine. Am I going to have these forever? I like them. I'm going to plan to stick with these for a while. These are my favorites. I have a few others that I didn't cover. And I may shuffle it up and shake it up a little bit. I also own several stocks as well because, like I said, I'm primarily a stock investor. I like what I do like about these ETFs is the diversification of risk and really the superior compounding that goes with that risk diversification, um, and the superior cash flow that you get from some of these specialized derivatives. And that's what these are, these covered call ETFs. They're really derivatives, if you will. So that, folks, that is it. And I thank you for sticking with me for these 52 minutes. I hope you found this to be useful and enjoyable and entertaining. And if you did, I'd appreciate if you give us a thumbs up, share the video with a friend, hit that notification bell so you'll know when our next video comes out, and subscribe to our channel, Dividend Blasters. Have a wonderful day. Merry Christmas, Happy Hanukkah, Happy New Year, and God bless you. And God bless America. Thank you.